This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
At the beginning of our studies of capital gains tax, we learnt what the basics of this tax were, and that was that a gain would arise wherever there was a chargeable disposal of a chargeable asset by a chargeable person. And a chargeable disposal arises on other than just, as you might think it to be, a sale. Obviously, the main way by which individuals or companies would chargeably dispose of an asset is by selling it. But what we'll discover is that there are other ways by which either individuals or companies, or possibly both, may dispose of an asset. One way an individual may dispose of an asset is by means of a gift. And a gift, therefore, for an individual, companies won't be making gifts, and gift by an individual is a chargeable disposal. Now, this will be a huge surprise so far as any individual taxpayer would be concerned. They may very well believe that if they were to give an asset away, then there couldn't possibly be any tax charge. Hey, I'm worse off, not better off than I was before, so there can't possibly be any tax. Well, they're going to be surprised to discover that here, in terms of capital gains tax, a gain will be computed based on the open market value of the asset being gifted, because a gift is a chargeable disposal. Now, of course, there will only be a gain to compute if the asset being gifted is a chargeable asset. And what that definition was, all assets are chargeable unless specifically exempted. Then, a chargeable disposal of a chargeable asset will be subject to capital gains tax. And what we'll do is that the donor, the person making the gift, is treated as making disposal at market value. So a figure that must be provided to us, or in rare circumstances, a basic rule learned, we need to know how and what is that market value there of the asset being gifted. Now, this relief is very similar in terms of the impact that it has as the previous rollover relief. The reason being, it is a deferral. There are different types of relief that we've made reference to at the introduction of this chapter. There are reliefs like entrepreneur's relief, where it's a tax rate, where on those qualifying business assets, a term that we'll use a lot in terms of CGT reliefs, on qualifying business assets, a tax rate on any gain chargeable would be 10%, rather than the more likely higher 10% rate. So a 10% tax rate. Rollover relief, that was a deferral. So a gain has arisen, but there are circumstances in which HMRC reasonably believe that although the gain has arisen and it cannot be exempted, they will allow it to be deferred till a future point in time. With rollover relief, it was that we'd sold one qualifying business asset and then reinvested the sales proceeds in another qualifying business asset. And to the extent that we, as it were, plough the money back, we reinvest those proceeds, then we're able to gain a deferral of the gain that has arisen. What now happens with gift relief, we compute a gain based on the market value of the asset being gifted. But then, if and only if that particular gift qualifies for gift relief, the gain may be deferred. Now again, it's a classic rollover, only this time that the gain being deferred will be deferred from chargeability now on the donor, the person making the gift, and will become the responsibility of the donee. And how will it become the responsibility of the donee? By reducing the base cost. So when gift relief is claimed, the donor's gain is deferred, and the gain is then deducted from the donee's base cost. We roll over the gain against the base cost of the asset to the donee, a cost that without gift relief would have been the same as the disposal consideration for the donor, i.e. the market value. So it's a simple enough process. For the donor, we compute a gain based on the market value. Take away the cost, get the gain. We then, if we claim gift relief, roll over that gain against what would have been the cost, the self-same market value of the asset, what would have been the cost to the donee. So that cost that allowable cost to the donee is made lower, meaning that when they dispose of that asset in the future, their gain will be that much higher. And at that point, unless again gift relief is available, the gain will then crystallise. So let's have a simple example of this, shall we? The issue, as I've said here, is not so much the principle, because the principle is a very simple one. Your problem is learning those particular assets where gift relief is available. Now then, I'll give you a little example here. Don't worry, we'll see the list of qualifying business assets in just a short while, but let's make sure that these principles are properly understood. So I'll tell you that taxpayer gifted some shares in an unquoted trading company. This, of course, will have significance, and unquoted trading company shares will indeed qualify for gift relief. Taxpayer gifted some shares in an unquoted trading company to his daughter. Oops. And what we're told is the open market value of those shares is £250,000, and the cost of those shares is £100,000. So, whatever the asset being gifted, a gain is computed based on market value. So that's simple enough. We now calculate the gain, open market value, £250,000 less our allowable cost, £100,000, and we therefore have a gain of £150,000. Nothing could be easier. Now then, what will happen with that gain with and without gift relief? Now, without gift relief, that gain would now be chargeable. And the donor would have to pay tax on the taxable part of that chargeable gain. If this were the only gain made in the tax year, then the taxpayer would have available his AEA, the annual exempt amount, to deduct from it. Then there'd be a question of what tax rate to apply to the taxable gain, the chargeable gain after deduction of the AEA there. And the next question that would then arise, thinking about there's not just one relief maybe to consider when dealing with a transaction, what about then the tax rate? Well, entrepreneur's relief. Would the shares in the unquoted trading company attract entrepreneur's relief and therefore suffer a 10% tax rate instead of almost what is certain to be a 20% tax rate in relation to this gain? Now, of course, shares in an unquoted trading company would indeed be potentially eligible for entrepreneur's relief, but you'd then have to apply those tests, wouldn't you? Do you recall, I hope you do, that for shares in an unquoted trading company to be eligible for entrepreneur's relief, the individual must own at least 5% of the shares in the company and must be an employee. So here, a problem. There are going to be different conditions and different definitions of qualifying business assets for the various reliefs that we see. What are qualifying business assets for ER, entrepreneur's relief, are not necessarily qualifying business assets for rollover relief, and not necessarily now qualifying business assets in relation to gift relief, and vice versa there. So we have to apply each relief's own checks. But now that chargeable gain would be chargeable on the donor. And to repeat, without gift relief, the base cost of those shares to the donee, the daughter here, would be, what is their market value? 250,000 minus what is the amount of the, without gift relief, base cost to the daughter will be £250,000. My apologies. Without gift relief, it goes to the daughter at market value. Question then, what happens with gift relief? We simply compute the gain on the donor as we did before. It was £150,000. Do shares in an unquoted trading company attract gift relief? Yes, they do. Therefore, gift relief, £150,000. Therefore, nil chargeable. This relief, as with most reliefs that we ever see, is not a question of the individual choosing how much of the relief to claim. The choice is, do I claim it or don't I? We can't make partial claims here, so if you claim it, the entire gain will be deferred. To the extent that the gain is eligible for relief, if the relief is taken, all of that gain will be deferred. The effect then for the donee. So the now base cost to the daughter will be, again, what was, of course, the market value of £250,000 minus the gift relief of £150,000 equals £100,000. Effectively, the daughter has acquired those shares at what was the cost to the donor, the father, there. So base cost to the daughter, market value minus the deferred gain. So there we go. Nice, simple little example of the way in which gift relief works. Now then, as we said, if having computed your gain here, 150,000, that the chargeable gain, subject to deduction of losses, subject to deduction of AEA, then the taxable gain, next question, is whether that taxable gain would qualify for entrepreneur's relief and therefore attract the 10% tax rate. If we instead claim gift relief, that gain is deferred from the donor and becomes the responsibility to the donee by reducing what would have been the base cost to the donee, i.e. the market value of that asset. Responsibility will then lie on her when she disposes. She'll have a cost of £100 instead of £250,000. Okay, let's just go back to our note. There's example 7 there, which you can have a go at in a few minutes' time. We'll just do a little bit more before we set you a couple of examples indeed to do. Let's just put a little bit more of the background theory into practice. We just mentioned about entrepreneur's relief. When a claim for gift relief is made, the donor may lose entitlement to ER. Well, of course they will. If a gift relief claim is made, the gain is deferred. If the gain is deferred, then there is no taxable gain to be taxed at the entrepreneur's relief tax rate of 10%. If the asset qualifies, then gift relief, if claimed, is of course applied before entrepreneur's relief. If you defer the gain, then there is nothing to be taxed at whatever tax rate may be applicable. If, of course, we do not take gift relief, then the gain becomes taxable, and then we need to know, does that disposal, does that asset qualify for entrepreneur's relief, and if so, apply a 10% tax rate. This relief only available to individuals, not companies. The admin, the boring bit, but the claim must be made by both the donor and the donee. It is a joint claim and must be made within 4 years of the end of the tax year. Must be made, careful how that reads, must be made by there or within 4 years. We don't have to wait 4 years and then make the claim. We must make it within 4 years of the end of the tax year. So any gift in the 2017-18 tax year that attracts gift relief for the gain to be deferred, then 4 years from the end of the tax year, the claim must be made by the 5th of April 2022. What is rather more important as a learning exercise is knowing what assets actually claim. Again, important for us to realise, just because a taxpayer gives an asset away does not entitle that taxpayer to claim gift relief and defer the gain, only if the gain qualifies because it is a qualifying business asset. Now, there are some other circumstances in which gift relief is available, but those are not a part of the F6, the Taxation UK F6 paper. They are a part of the P6 Advanced Tax paper. So what have we got? Assets used in the trade of the donor. So if you're an unincorporated trader, you're a sole trader or a partner in a partnership, but if you've got assets you own that are used in the trade of the donor, you're an unincorporated trader, then the gift of those, they are qualifying business assets. If you decide to give your business away to your son or daughter, then gift relief would be available. Then what about shares? Shares in the donor's personal company, see below. This extends the relief to assets owned by the individual, but not used by him directly trading person. Yes. Again here, assets used in the trade of. So before we get to the shares, assets used in the trade of the donor's personal company. Now then, personal company. Again, it is defined down here, individual's personal company, one where at least 5% of the voting rights are owned by the individual. So when we talk about personal, we mean it's not a lot, just 5%. So if an individual personally owns assets, as they would if they were a sole trader, an unincorporated trader, or it's the donor's personal company, so an individual, for example, might have his or her probably 100% shareholding in their company, while keeping personal ownership over an asset that is then used within the company. For example, I own shares in my company, and I also own the property that is used by my company. That particular asset there, assets used in the trade of the donor's personal company. Yeah, I own more than 5% or at least 5% of the shares. That means that I will be entitled to gift relief should I choose to gift that property away. Probably the most likely asset ever seen in exam questions for gift relief is this one. Shares and securities of trading companies, provided that one of the following conditions apply. The shares, it's usually shares, are not quoted on a recognised stock exchange, i.e. unquoted shares, and in a trading company. Gotta be a trading company. So any shareholding, whatever percentage, in an unquoted trading company is going to be eligible for gift relief in relation to a gain made on their disposal. Or any level, any shares in any company if it is the individual's personal company. What made it personal? You own at least 5%. So what this is telling you is if you own 4% of the shares in an unquoted trading company, then those shares, no limit in terms of the percentage required, those shares, when gifted, would attract gift relief. Whereas, if you owned a 4% interest in a quoted trading company, then because it's quoted, you have to have 5%. It has to be your personal trading company. If you only own 4%, then any such disposal of any or all of those shares will not attract gift relief. It will not attract gift relief. So any shareholding in an unquoted trading company, shares in a quoted trading company, only if prior to the gift you own at least 5% of the shares. What we have seen in the example I gave you a moment ago, and we'll return to it in a moment's time, is an outright gift. The individual had shares in an unquoted trading company, which now you have seen do qualify as qualifying business assets. And we made an outright gift of those shares, or he did, to his daughter. But maybe the taxpayer concerned is unable to afford to make an outright gift. And therefore, makes a sale at undervalue. So with my example, the shares that we had before, let's just go back to that, they had an open market value of £250,000. Yeah, and it was an outright gift. What we'll now presume here is that the taxpayer sold the shares to his daughter for, oops, well, we've got that up there, for half the open market value. So couldn't afford to make an outright gift, but instead sold them at undervalue, sold them at half their market value here. Okay, what would happen in relation to this? Well, just go back to the note. Gift relief is also available for sales made below market value where there is an element of gift. So there is a donative intent. You intend there to make a gift. You just can't afford to make an outright gift. The problem now is if it is a sale at undervalue, there is cash being received by the donor. It's not an outright gift. Cash is being received. And if cash is being received, there's a question mark, therefore, whether some of that gain should still remain chargeable on the donor. So there has to come a point where the actual proceeds received become sufficiently large as to state that gift relief would not now be available in full, but if proceeds go above a certain figure, then pound for pound, amount of that gain will be chargeable on the donor. And the cut-off is a very simple figure. Any actual proceeds received in excess of original cost, there's the point, if actual proceeds exceed original cost, then that amount of the gain will be chargeable to CGT immediately on the donor. It'll be denied gift relief. The gift relief is therefore reduced by this amount. So let's have a little look at what we've got. Taxpayer sold the shares to his daughter for half their market value. Now then, the fact still remains that there is an element of gift. Wherever there is a gift, what do we use as a disposal consideration? You do not use these actual proceeds. You still and always will use the open market value. So whether it was outright gift or sale at undervalue, you use here the market value of £250,000 of those shares in the unquoted trading company. So your calculation of the gain is exactly the same. Market value 250, cost 100,000, gain £150,000. Now there is the question of how much of that gain should be allowed to be deferred through gift relief, and whether or not even following a gift relief claim, any of that gain should remain chargeable. And what we do here is a little bit like what we did when dealing with rollover, where it was only partial rollover. What we did was to calculate the amount of the gain that remained chargeable, and the difference between that, the bit that remains chargeable, the bit to go in there, and the amount of the gain, well, that difference will be the deferral. Here the gift relief, previously the partial rollover relief. So this is the bit that we actually calculate. It's a very simple calculation. All we do is to look at the actual proceeds and to see whether or not they exceed the actual cost. It was a sale at half their market value. There's the market value, 250. So the actual proceeds received from the daughter would have been half of 250, 125,000. So the bit that remains chargeable, if any, actual proceeds minus actual cost. There is the cost, 100,000. Do actual proceeds exceed actual cost? Yes, they do. by how much? 25,000. So that amount of the gain that's, if you think about it, has actually been made by the taxpayer. He bought for 100,000. He's actually received cash proceeds of 125. He's actually made a gain of 25,000. That 25,000 will remain chargeable. The gift relief, therefore, is a balancing figure. What is that figure? Well, 25 compared to 150 is 125,000. So the gift relief, a balancing figure between the amount of the gain arising and the amount of it that is now immediately chargeable. That's the bit that you calculate, actual proceeds minus actual cost. That's the level of chargeable gain that arises here. What does it mean? It means that for the donee, the base cost to the daughter, as we'd always do with ever any gift relief claim is made, it will be the market value, 250, minus the gift relief, that is this time £125,000, and that therefore will give us 125,000 as the deemed cost to the daughter to use on any future disposal of those shares by the daughter there. So now, whether or not the gift, in inverted commas, is either outright or is a sale at undervalue, we now know how to deal with it. Irrespective, we always base the gain on open market value. Doesn't matter whether it's a sale at undervalue or outright gift. Always compute the gain based on market value. Take away cost, get the gain, then deal with the gift relief. But with a sale at undervalue, the gift relief is a balancing figure, after having firstly worked out how much, if any, of that gain is going to remain chargeable. How do we do it? Actual proceeds minus actual cost. If actual proceeds, as here, exceed actual cost, that is the amount of the gain that will remain chargeable. What would happen to the donor if that were the only gain made in the tax year? 25,000 chargeable, take away the AEA, get your taxable gain, and then consider the tax rate. For that, we would need to know, would these shares qualify for entrepreneur's relief? If they did, it would be a 10% tax rate that would then apply to that taxable gain. If they did not qualify for entrepreneur's relief, then from the income tax computation, we'd need to know the taxable income. And if, for example, the taxpayer was a higher rate taxpayer, then the 20% tax rate would be applicable. Once, however, we've determined the level of gift relief there, it is that figure that is then deducted from the market value in determining the base cost to the daughter. Okay, let's go back to our note. There's a couple of examples here now for you to have a little go at. There, example 7, where, assuming David and Tommy make a claim for gift relief, calculate Tommy's base cost of the asset. So there it will be a full claim in relation to gift relief, assuming that the asset qualified. Then, example 8, Richard acquired a 25% holding in an unquoted trading company. Is that going to be eligible for gift relief if we make any gift out of that shareholding? Yes. In fact, at 25%, it wouldn't matter whether it was unquoted or quoted, because it would be your personal trading company, you'd own at least 5%. If, of course, this was 2.5%, then being in an unquoted trading company, any shareholding in an unquoted trading company would be eligible for gift relief. Acquired at a cost of 60,000, became an employee of the company. In March 18, sold the shares to his son for 85,000, when their value was £200,000. Richard and his son claimed relief for the gift of a business asset. Right, that's as per the example we've just done, and therefore I need you to work those two examples, please. So would you do that? Check through with the answer at the back, make sure that we're happy with it, and then come back and join us, and we'll complete then the remaining issues that are to be dealt with in terms of gift relief. Well, hopefully question 7, example 7 here, I should say, gave you no problems at all. Pretty basic gift there. Again, we pick up the market value as the disposal consideration, £100,000, as we see here. Take away the cost as you normally would in a gains calculation, and that gain of £40,000, then as it's an outright gift, it's a qualifying business asset, and on that basis gift relief is available and all of the gain is deferred. How does it work? Then what would have been the base cost to the donee, Tommy here, that would have been the market value of £100,000, is now of course reduced by the gift relief, the deferred gain, bringing down the base cost to the donee to a deemed cost of £60,000. A very much more interesting problem was example 8, whereby we were told in the question, again, we were dealing with shares in an unquoted trading company, and we realised on that basis that gift relief would be available. But of course, rather than being an outright gift, it was a sale at undervalue. Still, that made no difference in calculating the original gain. That is still market value, 200,000. Take away the cost, we get the capital gain of 140. It's then a question of what gift relief would be available. Now, again, the way that we would do it is to work out what is the gain that remains chargeable, and then take the gift relief as the balancing figure. How do we work out what is chargeable? We look at the actual proceeds received minus the actual cost. The cost, as we know, £60,000. The proceeds were told, £85,000. So we can see that actual proceeds exceed cost by £25,000. That amount of the £140,000 gain remains chargeable, leaving therefore £115,000, 140 minus the 120 minus the 25 there, as being the gift relief available. It leaves, as we say, that £25,000 chargeable. That is then subject to, as it's the only gain of the year, to the deduction of AEA. Take away that to get your taxable gain. Then look again at what the asset is. Shares in an unquoted trading company where the individual is an employee, and we've had that situation for at least 12 months. That means, therefore, that that gain is eligible for entrepreneurs' relief, so that the taxable gain will then be taxed at 10%. So within one example there, we've got two reliefs being tested. So we've got the initial availability of gift relief that will defer the gain, but not all of the gain, where if actual proceeds exceed actual costs, that amount of the gain remains chargeable now on the donor. Anything that is chargeable now, separate question, if there is then a taxable gain post the deduction of AEA, will entrepreneurs' relief be available? And where you've been an employee, own at least 5% of the shares, have been so for at least 12 months, entrepreneurs' relief is available. So the tax rate is 10%. If ER, entrepreneurs' relief, were not available, then of course it would be a 20% tax rate if our taxpayer is indeed a higher rate taxpayer. What happens to the donee, to Richard's son here? Well, what would have been the base cost, the market value, is then reduced by the extent of the gift relief to bring us down to a base cost of £85,000 there. That one, as I say, a much more interesting problem and very much more the type of scenario that we might see within an examination question. Okay, just pause here, then I'll take you back to the section in the chapter. There's just one other restriction that we've got to see as regards the availability of gift relief, and we'll do that in just a moment. But if you turn back to chapter 14, find where we got up to, and we'll pick it up from there with just a couple of more minutes of work to do. Okay, final part is regards now the application of gift relief. As we've said all the way through, you don't just get gift relief because you're giving an asset away. You get it because the particular asset being gifted is a qualifying business asset. So what about if we've got a situation where only part of an asset is used for trading purposes, or an asset has been used for only part of the donor's period of ownership? Then the gift relief is restricted to just the business use period and the proportion of the asset that qualifies as business use. But where you're most likely to see this, if it's to be tested at all, is here. We go back to shares as being the most popular question area in terms of gift relief, where the gift is shares and the individual owns at least 5% of the voting right. So again, your personal trading company. Again, it would have to be a trading company, of course, there. Then the capital gain on the shares eligible for gift relief is restricted to something you'll come to know and love as CBA over CA. Market value of the company's chargeable business assets. There's your CBA, chargeable business assets, over the value of the company's chargeable assets. Now, what is the difference between it? The difference between the top line and the bottom line is that there will be, again, in such a question, on the balance sheet of the company, you'll be given the market values of the assets, and lurking on that balance sheet of the company, there will be an investment. Now, investments, of course, are not trading assets and therefore would not of themselves attract gift relief. So where there is a balance sheet, which of course is mostly, vast majority no doubt, is of business assets, but you've got an investment, then we have to restrict the gift relief to this fraction, CBA over CA. Now, this is entirely different to what we do for entrepreneurs relief. Here, it is a proportion. In entrepreneurs relief, there's no question of apportionment. Either the company will rank as a trading company, and therefore it will attract entrepreneurs relief, or it will not be a trading company, and on that basis there will be no entrepreneurs relief. But with gift relief, to the extent that we have investments as a proportion of the chargeable assets, we will restrict gift relief to CBA over CA. So what are these chargeable assets, these chargeable business assets? The word chargeable, only those assets that therefore would be chargeable to capital gains tax. Now, an asset cannot be a chargeable asset where any profit that might arise on its disposal would not be a chargeable gain. This provision therefore rules out current assets, your stock, or inventory if you prefer the more modern word, debtors, receivables there, and exempt assets such as cash, motor cars and any other exempt chattels there. So we will be talking about just the chargeable assets of the business, those whose disposal would otherwise give rise or could give rise to a capital gain. Now, what will they be? Chargeable business assets, of course, those chargeable assets that are used for the purposes of a company's trade, and that would include the value of goodwill there that was acquired before the 1st of April 2002. Again, just a cut-off deadline that we need to be aware of. But would exclude shares, securities, and other assets held as investments. Right. Now, what are the most likely assets that we'd see? Here, listed out in an example, is or are the market values of assets owned by a company at a point where some of the shares are gifted in that company. Freehold trading premises. What do you think that is? Do you think to begin with it's a chargeable asset? Could a gain arise on the disposal of the freehold premises there? Well, yes, it could. Is it an asset used in the trade? They're trading premises. So that we label as a CBA. Goodwill. Now, what do they tell us about the company? John owns 100% of the shares in John Limited. He is the MD, so he's an employee. More of that later. Made a gift of the shares to his son when the market value was 800,000. The shares had cost 200,000 in February 2001. That therefore means that the company must have started to trade prior to the 1st of April 02, and therefore the goodwill represents a chargeable asset. If the company had started trading post the 1st of April 02, though of course still an asset, goodwill will be reclassified as a trading asset and therefore would not be included in this calculation. So here, goodwill, chargeable business asset. Then, very obviously, investments. What sort of investments? Now, the question might just tell you, like I've done there, investment, so as to make it very obvious. But of course, if you had an investment property, one that you don't use in the trade but is used for purposes of letting, clearly not a business asset used in the trade, that would be a chargeable asset but not a chargeable business asset. Shares in other companies. So what you've got is a chargeable asset. Then of course the others, stock, work in progress, debtors, cash, they are not chargeable assets. So here your CBA over CA, your chargeable business assets, the business premises and the goodwill, 700, over all chargeable assets, both the business plus investments, that would be 800. Now what the issue is here is only that fraction of the gain will be eligible for the gift relief deferral. Another one to watch for, plant and machinery. Now, not mentioned here, but if you had plant and machinery, the assumption would be that it would be a chargeable business asset unless, hopefully you remember that, the Chattel Exemption applies. Now, the Chattel Exemption that we talk about, if you were told plant and machinery £200,000 on the balance sheet, no other note, that's a chargeable business asset. If you're told plant and machinery £200,000 and it then says in a note contains no items valued at nor costing more than £6,000, that would mean that the Chattel Exemption would apply. If it's an exemption, then it can't be a chargeable asset and would not therefore be included as a chargeable business asset. So plant and machinery starts off as being a chargeable business asset unless they're telling you, without using that precise wording, that the Chattel Exemption applies. That depends on whether the plant and machinery concerned has cost less than, each item that is, cost less than, and each item is still valued at less than £6,000. Right, we've got to calculate John's CGT on the disposal of the shares in John Limited and the base cost of the shares for his son. To calculate the capital gain to begin with. Now again, that should be straightforward enough. What's the market value? It's 800,000. What was the cost of the shares? 200,000. So we've got ourselves therefore here a gain of £600,000. So a nice simple basic gains calculation. We know that given that they're shares in an unquoted trading company, that gift relief is available. The issue is that not all of that gain of 600,000 is eligible for gift relief, only to the fraction of CBA 700,000 over CA 800,000. So 7/8 of that gain is therefore going to attract gift relief. Well, if you put that through your calculator, then hopefully we discover that the gift relief 7/8 of 600,000 is £525,000, leaving therefore still £75,000 as being chargeable. If that is the only gain of the year and there are no other capital losses to deduct from that gain, we get our AEA of £11,300. That brings us to a taxable gain. Understand the difference between your chargeable gain and your taxable gain there. That's going to be, what's that, 63,700. Taxed at what rate? Look again at the information in the question there. John owns 100% of the shares. He's the managing director and has been so. The shares cost $200,000 in February 2001. Well, he's definitely had the shares and been an employee for at least 12 months. So all of the conditions are in place for entrepreneurs' relief to be available. Taxed at 10%. If this is a written question, note 1 to explain, of course, why it is that entrepreneurs' relief is available there. Taxed at 10% on 63,700 is, assuming those numbers to be correct, £6,370. In relation, of course, to the donee, then John's son, the base cost would be the market value, so base cost to son, would equal the market value of 800,000 minus the gift relief claimed, that is 525,000. Take it away, and the son would have a cost of 275. That, of course, then to be used on any future disposal by the son of the shares in that company. Gift relief, therefore, hugely important. These CGT reliefs are bound to be tested at some point, somewhere in that examination, whether that's in Section A or Section B, probably rather more than Section C, but it's still a possibility in Section C, but they're going to be somewhere. You need to know. Right, make sure you've reviewed through the answer to that question. Make sure that you're happy with it. That is 3 of the 4 reliefs now dealt with. There's one further one, as you can see, sneaking in down here. The last one for us to look at, which will be our next and final lecture on this chapter, Principal Private Residence Relief. And in that one, you see then a third type of relief, inasmuch as we started this chapter with entrepreneurs' relief. That was a tax rate. It was a lower tax rate. It was 10%, thus halving probably what would have been the tax charge at 20% on gains on qualifying business assets. Entrepreneurs' relief, therefore, a lower tax rate. We then had rollover and as we have just seen, gift relief. Those are deferrals, where a gain that should have been chargeable now is not now chargeable. It won't be exempted, so we compromise and we defer the gain to a future point in time. With rollover, the disposal of the qualifying business asset that has now usually replaced the original asset, or in terms of gift relief, where we reduce the base cost of that asset to the donee, thus making the donee gain responsible for the future bigger gain when they dispose of that asset. But principal private residence relief is as good as it gets, because what that is an exemption. What that will allow is for some, possibly all of the gain arising on the disposal of your principal private residence, basically your family home there, the potential for all of that gain to be exempted. Not deferred, not have a lower tax rate applicable to it, but to be exempted there. What we'll discover, of course, is if we simply bought our house, lived in our house, sold our house, then all of the gain arising would be covered by the principal private residence relief. The only thing that can make it exam worthy is the fact that during the period of ownership, between buying and eventually when we sell, there are periods when we did not actually occupy the property. And what that will then come down to is us appreciating what is noted there, that we will limit the PPR relief to that. Pretty obviously, the period of occupation over the period of ownership there, period of occupation over ownership. But when we talk about occupation in terms of this calculation, a calculation done, by the way, to the nearest month rather than any other rounding. We don't do it to the nearest year, but to the nearest month there. But occupation doesn't have to be actual. There are periods of deemed occupation. Now, those simply have to be learned. I'll show you in the next chapter in the next session, how they are applied. But you are going to have to learn them. Wouldn't be a bad idea, therefore, if you have a little look through that, just this section of the note, 4.1, 4.2. Don't go on to example 10. I'll take you through that before I see you next time. Okay, look forward to finishing off this lengthy chapter with you in our next session together.